So just to give you a little bit of reference here, how many were in the session right before this one? Okay. I am Gale Kirsopp, and I am the CEO and the founder of 4700 Group. I tend not to call myself an accountant, though I am, because everybody has a connotation of what an accountant is, and we don't do taxes, and we specialize in reporting, and all sorts of things that don't fall in that bucket. So I tend to identify myself as a cash tracker consultant, and I'm a technologist. And as you can tell, everybody in 4700 Group is both Clio certified as well as QuickBooks Online certified, so that we truly specialize in the area of the integration between those two. I'm an avid hiker, I'm an avid reader, and I'm a coffee connoisseur. In other words, I live in Seattle, Washington. And we're going to talk about following the cash. That's what we're going to talk about today. So let's talk about the session objective. What I really want to do is I want you to leave here with an understanding of why your firm should be reviewing your accounts receivable report and your cash flow statement on a regular basis. Now, both of those reports are wonderful terminology for accountants. And unless you've had some sort of training from an accountant or in law school, both of those reports tend to be, yeah, somebody puts it in front of me and I have access to it, but I really don't know what it's trying to tell me. And so we're going to spend time today taking those two reports and discussing how we actually need to have those modified. So we're going to start with the very obvious. What is cash? Something that you can spend? I mean, I don't really mean it as a rhetorical question. I really mean it for you to think about it, because there truly gets to be some confusion as far as what cash is, okay? It is the lifeblood of any firm. No question about it. And without it, your firm will not survive. Period. This isn't about getting more clients. You can have all the clients that you can possibly handle. If you don't have enough cash to pay your indirect costs, your payroll, you will go out of business. So cash truly is the most important thing that you need to be tracking. So that leads to the next question, which is, what is accounts receivable? There you go. Cash that's not in your pocket, okay? But there does seem to be a confusion in a lot of legal firms that accounts receivable is equal to cash, and it is not. Because really, what accounts receivable is that it's a loan to your client. Now, I want you to think about that for a minute. I'm just going to let that sink in. You've done the work. Whether you have completed the case or the matter, or whether or not you're still working on it, you've already done the work. You've billed them. And now you're waiting for them to pay you. Sounds like a loan to me. If you go to the bank and you borrow money, you got to pay it back. So what does the legal profession do? we discount it. Because if they didn't pay it to us in a timely manner, we're going to discount it in hopes that they're going to pay us. That's pretty standard protocol as to what we see. And what I'm going to say is, if you are making a loan, what are your terms? What terms do you give your client? And at what point do you tell your clients what your terms are? Is it in your engagement letter? Do you spell out what your terms are in your engagement letter? Is it the first time they hear what your terms are? Is it when they receive the bill and maybe down at the bottom there's a little line that says payments due in 30 days? So if you don't tell your clients what your terms are, we're expecting a behavior from them without them knowing up front what that behavior should be. Now, if they don't pay, do you have processes and procedures in place to take it to the next step? Or do you wait until something is 45 days late, 60 days late, 90 days late, and then go, yeah, somebody needs to call them, find out when they're going to pay us? Or let's discount it and send them another and see if they'll pay it. Okay? So if we haven't communicated to the client what our expectations are, we're expecting them to behave in a manner that they didn't realize that they had to behave in. And that's a problem. And then internally, are you doing what needs to be done? Now, how many people in this room have children or grandchildren or something that is small? What happens when you tell them to do something and there are no consequences for them not to do it or to do something that they shouldn't do? It doesn't work, does it? There's got to be a consequence. If you have not defined your terms in your engagement letter so that the client is aware of what the consequences are, and discounting a bill is not a consequence. Okay? Your client needs to know what is the consequences of not paying that bill in the terms that you have established for them. And that should be part of your engagement letter. It should be reminded to them when you bill them, and you should, as soon as the bill is late, you should be implementing, or somebody in your office should be implementing, or if you have outsourced your accounting work, they should be implementing the consequences that you defined. There has been several research studies done that will talk about the fact that the sooner you bill after completion of services, the sooner you will get paid. And it's something to think about. So, here is a typical aging report. I intentionally took it out of any piece of accounting software. But what I want you to realize is, I want you to look at this report. They're not going to let me do it. And I want you to look and see that the columns are set up so that you have current, 1 to 30, 31 to 60, and 61 to 90. Well, what I'm going to tell you is this report's great if your terms are 30 days. If your terms are 14 days or 20 days, this report doesn't really help you. Now, granted, this is a standard report that comes out of In this case, it came out of QuickBooks Online. But the point is that you need to be looking at reports that align with what your terms are. Not reports that somebody put in front of you and said, here's your aging report, you need to look at this. Because if you look at this and you have terms that are 20 days, there's no correlation. Okay? So is Becky Hilton late? You don't know. So those consequences, should they be implemented? You don't know. That could have been 2 days. That could have been 30 days. What you need to do is make sure that you have a report that is customized to match your terms. So in this case, we now see that if our terms are 15 days, we can now see that we do have 2 that are actually late, because there they are in the 16 to 30. Okay? So your AR report is going to be far more valuable. Your accounts receivable report. If you aren't doing this yourself, make sure that your outsourced bookkeeper or accountant is doing this for you. These need to align with whatever the terms are that you give your clients, because this should immediately trigger whatever that consequence is. Maybe at 15 days or 16 days, the consequence is a letter and you're going to assess a finance charge at 30 days. That's entirely up to you, but there has to be that consequence. So the question becomes, how often do you review your accounts receivable report? So when we go into a legal firm, one of the first things that we do is we ask them what their terms are, and we ask them how frequently they review it. Do you know what the most common response is? When we get low on cash. What I will say is getting low on cash is not a good motivator to go look at your accounts receivable, because if that's the case, your consequences have not been done in a timely manner. And the farther from when you complete the work to when you bill, the less likely you are to receive that payment. And I would really love to see everybody in this room get rid of the concept of discounting when somebody gets to be 30 days late or 60 days late or 90 days late. And more often than not, what I hear is, we'll discount it because we want to get paid, but we just won't work with them again. And they're going to be the first one at your door because you didn't charge for your time. Okay, so what's the next thing that we want to look at? Well, this is one of the things that we hear quite frequently from our clients. Okay, but I already look at my income statement. Why should I also look at my accounts receivable? Well, there's lots of reasons. Your income statement tells you what you billed. Your accounts receivable talks about what's still owed to you. Those are 2 totally different things. So an income statement, which is also called a profit and loss, does not address cash. It addresses the income, how much income you've generated. Most accounting firms want to know, how much income did we generate last month or last quarter? What's that bottom line? What did we bring in? I love this one. Yeah, but I don't trust what the report says. That's always a little unsettling. But I think even more unsettling is when we get a call from a firm that says, I'm really concerned because I ran an income statement or a profit and loss, and that money's not in the bank. Okay? So your profit and loss said that you made $20,000 last month, and your bank account is not showing $20,000. So what I propose to you is, wouldn't it be great if we could reconcile the cash in the bank to the income statement? Well, actually we can. And we can do that with what we refer to as a cash flow statement. It is also known as a statement of cash flow. Now, one of the biggest problems with this financial is that if I show you what this financial looks like in accounting terms, everybody who is an attorney will get up and walk out of the room, and everybody that has an accounting background will stay, and I will be talking to nothing but the accountants and the bookkeepers, and the attorneys will all be gone. And that is because this particular report, if it's issued as a standard report, makes no sense to a legal firm. And so what I propose and what we're going to do today is we're going to take that cash flow statement and we're going to rebuild it. And we're going to rebuild it from the ground up so that from a legal firm's perspective, it makes sense. And then what I want you to do is I want you to go back to your firm and I want you to either use it or to hand it to your accountant or your outsourced bookkeeping and say, this is a report that I need to see on a regular basis. Because this is truly tracking the cash flow. All right, so there are 3 sources of cash in any firm. One is cash from a firm's core business. Now, when I talk about core business, this is not cash that comes into your IOLTA account. This is not cash that comes in to repay your advanced client costs. I am talking cash for your core business. These are the fees that you charge. If you do have good terms and you assess income, finance charges on late bills, that would not be considered part of the firm's core business. Am I clear on what core business is? Okay? Because we really truly want to look at your fee structure or your and your partner's fees, or that's what we want to do. Then we have cash from financing and we have cash from investing. So those 3 are the 3 different ways that sources of cash in your business. Okay. So we talked a little bit about removing the cash for advanced client costs and only considering the cash from your fee structure. Cash from financing. Cash from financing are things like bank loans. Do you have a line of credit that you tap from time to time? Do you have, from time to time, does a partner have to put in additional contributions in order to meet payroll? Now, I'm going to take it a step farther because I have seen in many firms, I mean, we've been working with legal offices now for, 8 going on 9 years. And I love the one where the attorney writes a check to themselves and then doesn't cash it. And they've got it over here. And it's sort of like, well, why aren't you cashing your checks? Well, I need the cash in the account. So I just write them and I leave them over here. And I will tell you that then that cash belongs in financing because, like it or not, you're reinvesting that money in the business. And even though you've got a check sitting over here, if you're not cashing it, it's financing. It's the same thing as cashing it and putting it back in the business. Okay? So that's what your financing is. So I want you to think about it. Now, there's all sorts of small businesses that have been developed recently where if you give them access to your either your Xero or your QuickBooks, that they will give you short-term funding based on your accounts receivable. Okay? That would also fall into this financing. The last source is what we refer to as cash from investing. And I'm going to tell you that unless you are in a firm that has somewhere 15, 20 and up partners in it, this is not part of a cash that you need to be concerned with. What is cash from investing? You know, this is, did you spend cash on a building? Did you spend cash on inventory? Did you spend cash on those very physical, tangible things that have taken a lot of cash out of your business in order to invest in? Okay? And by and large, most firms that are up to 12 or 15 partners really are not into buying a building or buying the additional physical capital type things. Now, if this does affect your firm, it's real easy to add it back in. So, now, this is the basic skeleton of what we use at 4700 Group for our cash flow statement for legal firms. Now, right now, I took all the dollar amounts out of it. But what I want you to look at is I want you to look at the fact that we start with cash at the start of the period. You can do this for any period of time. For the month, for the quarter. You can do a statement of cash flow or a cash flow statement for any period of time. The starting point is what is your cash at that point in time. So go to your bank account. Now, we use this because we provide this at the end of the month when all the accounts have been reconciled. So we know that everything's been reconciled, so we're very confident about what that cash balance at the bank is. And then what we want to do is we want to look. Very first thing, cash from the firm's core business. First thing we're going to put on this is your net income. Now, you're not going to be able to just pull a profit and loss or an income statement because depending upon how your accounts have been set up, you may have your advanced client costs in there. You may have your reimbursable income in there. Maybe not. So some of this has to do with how are your accounts set up. But you're going to pull that off of your income statement. Then what I want you to do with your accounts receivable is I want you to think about this, because this could be a positive or a negative number. And what I want you to do is think about it from a standpoint of, was more money coming into the firm, or was I loaning more money than I brought in? Now, this is in the aggregate, okay? You're not looking at individual people here. You're looking at the beginning of the period last time, how much was my accounts receivable? It was $10,000. At the end of the period, it was $8,000. So what does that mean? That means you brought in $2,000 from accounts receivable. If those numbers were reversed, you would be loaning that money. The next one is vendors' bills that you did not pay. So did you actually hold back some of your vendor bills? Well, I don't really have enough cash to pay for those. So maybe I'll wait until next month. And then you have cash from financing. Yes?
So the AR number is a delta between beginning of period.
Correct. Absolutely. Same thing for vendor bills.
Is the AP the same?
Yes, the AP is the same thing. Okay, that's an accountant talking to an accountant. Okay. Cash from financing. Did you tap that line of credit? Did you take some more money out of your line of credit and add it into the business? Or did you repay some of that? And those are what the bottom two lines are. So, yes, I borrowed additional from my line of credit, so therefore I brought cash in. And it's not uncommon that you're going to have a number in each one of those. You tapped your line of credit, but you paid part of it back. And then you have your cash at the end of the period. So we're really going from cash at the beginning of the period to the cash at the bottom, at the end of the period. All right. So let's look at this with some numbers. Cash at the start of the period, $76,592. Net income, and we're going to assume right now that the net income is correct, that the income statement is correct. So for the period, and the period's not been defined here, the period was $27,654. My accounts receivable was reduced by $1,600. My vendor bills not paid were $165. I borrowed no additional money, and I actually did repay $1,200 of the line of credit that I had borrowed against last month. So I have ending cash at the end of the period of $101,611. The biggest bugaboo on this whole thing is going to be your accounts receivable. And I want you to really think about it in terms of cash. Did you bring more cash in, or did you make more loans to your clients? So were your accounts receivable increasing in the aggregate or decreasing? That's really what that number is saying to you. Questions on that? Yes?
That accounts receivable, it's for the same period or
Same period.
starting from the previous period?
So what you do is,
At the end of the previous period, I had 2,000 in receivables. At the end of this period, I have 400 in receivables.
correct,
1,600.
correct, correct. Everything's in the aggregate. You're in a cash flow statement, you're not looking at the individuals. You're looking at what was my balance in accounts receivable at the end of last period, and what is it now at the end of this period.
So in effect, you're treating the receivables as cash?
Well, the thing is that your net income does not address your receivables at all. So you have to look at your receivables, because as long as you are billing your clients, that money can come in a totally different month than when it showed up on your net income.
And if you're keeping your books on a cash receipts basis?
Then you never bill a client. Okay, and let's talk about that for a minute. Because there is the concept of, we run a cash business. Well, if you run a cash business, you do not bill your clients, because they've paid for it before they've walked out the door. That's a cash-based business. Does everybody understand that concept? If you are a cash-based business, that means that before somebody leaves your office or your place of business, they have paid you for the services. As soon as you start billing for your services, you are no longer a cash-based business. That's a whole different thing. You can report both your taxes and your excise taxes, your municipal taxes on a cash basis. Absolutely. Absolutely. And you can still be running your business on what we refer to as an accrual base, which is what you do when you bill a client. That doesn't mean that you can't pay your taxes on a cash basis. Those are two totally separate concepts, okay? But you can't invoice somebody. You cannot bill somebody and be a cash basis. Are we clear on that? Paying your taxes is one thing, and you can most certainly do that. You can most certainly do that. But, and the thing is that we have never, in 8+ years, come across a legal firm which operates on a cash basis. They pay taxes on a cash basis, but we've never come across a firm that operates on a cash basis. The closest thing to it is contingency work. We have a couple personal injury attorneys that do 100% contingency work. That's the closest thing to it.
So on the income,
Mm-hmm.
you pull that from a P&L that was on accrual basis?
Absolutely.
Okay.
Absolutely. Okay, so that in and of itself is helpful. But what I'm also going to say is, now what I want to do is, and let's go back. Now, look at this. There's really 3 numbers that I want you to look at. And forget all the other peripheral, because everything else remains constant. Look at the cash at the start of the period. Look at the accounts receivable. And look at the cash at the end of the period. Okay? Those are the only 3 numbers I want you to focus on. And trust me, I'm an accountant. All the other numbers are the same. Okay? Your accounts receivable went to $15,000. Look what happened to your bottom line. Your net income didn't change. Your net income did not change. The only thing that changed on that cash flow statement is your accounts receivable. And you got paid for a lot of those open bills that were paid this month instead of when you billed them last month. So now your cash at the bottom is significantly increased. And this is where a lot of firms get into trouble, because they look at their bank balance and they go, wow, I got $118,000, without understanding that that's not reoccurring revenue, that what it is you got a bump because a lot of your accounts receivable got paid off in that month. So you can see how that really directly affects the bank balance and how much cash you have in your bank. So let's look at it differently again. Reports are good. But as all accountants know, we're always accused of looking in the rearview mirror of what happened. Okay? So how do we actually take this information and see what is happening and make some kind of future forecast? Well, the true power of reporting is when you start doing what we refer to as comparative reporting. So, let's go back. I'm going back to the statement. Just want everybody to be refreshed. We're back down there with the $118,211 in the bank. And now what I'm going to do is I'm going to show you how when we look at multiple months together, what we end up seeing. So in June, we made $76,592. And then you can see what actually happens. In July, we made $30,847. So basically, our income increased by approximately $3,200 or $3,200. But look what happens to our cash in the bank. Changed a whole lot more than $3,200 or $3,200. And it all has to do with our accounts receivable, which goes back to the importance of knowing what those terms are that you actually give to your clients, making sure that you are defining those terms. Look at the impact that it has on your cash. It's huge. It's absolutely huge. And it all starts with your billing. All of this starts with billing. How frequently do you bill? Do your clients know what the terms are of those bills? Do you have consequences when they're not paid in a timely manner? Because you have consequences. You have significant consequences. Where are you going to make up the difference in the cash because you can't meet payroll? You're going to go borrow money from your line of credit, and I can guarantee the bank is going to charge you interest. Okay?
I'm sorry.
Sure.
On those numbers, if I'm reading it correctly, accounts receivable went down by 17,350?
No. Let's look at it by the month. So in other words, accounts receivable, in June, you collected an additional $15,000 from prior months, okay? But now in July, what you're saying is the money that you brought into accounts receivable was less than the money that you loaned out in your accounts receivable. Yes?
Okay, so what you're showing is the accounts receivable line is not the accounts receivable that would be on the balance sheet. This is an actual collection from accounts receivable.
This is the difference between your two balance sheets accounts. Okay? So you would have your balance sheet from May and your balance sheet from June, and that variance, that difference, that delta.
So how do you account for shareholder distribution, owner draw, whatever the entity is? Because that cash, I don't know any attorneys that keep that cash in the bank. They pay themselves.
Correct. But okay, so obviously if they are paying themselves through the business as an employee, if you're doing,
No, but they're not on payroll.
if they're not on payroll, then you would have, that's where you would actually introduce the third form of investing, because you would actually have that distribution, that shareholders' distribution is going to actually come out as investing income.
But negative.
Absolutely. Absolutely. That's cash that's coming out of the business. Absolutely. And we're going to take it one step farther, and we're going to look at August. Now, again, here you get into the ebbs and the flows of what's actually happening. And the thing is that if you look at your net income is, again, it is increasing, but it's increasing at a far slower rate than what's actually happening to your line, to your credit, your cash in your bank. Okay? So you've got a lot of fluctuation that's actually going on there. Now, there are several different assumptions that you are making here. Number one is that your net income that's coming off of your income statement or your profit and loss is accurate and correct. Okay? And that goes back to one of the first things is you have to have confidence that your income statement or your profit and loss is accurate. And things have been posted correctly and into the right account. Your accounts receivable needs to be accurate. In other words, if you have somebody in your accounts receivable that is 120 days old, what is the likelihood that that will be paid? And is it time to write it off? I think there is this perception that as long as we leave it on an accounts receivable, that somehow miraculously it's going to be paid. Well, if you have outstanding debt from your client, in other words, your client's owed you money for 120 days and they haven't paid it, what's the likelihood they're going to pay it? And again, what's your policy? And I know a lot of legal firms that go, we would never send anybody to collections because we don't want them to complain to the bar. And what I will also say, because we work with many, many bar associations throughout the country, is if you have written terms, if they are part of your contract, and if they are stated again on the bill, the bar will support you in collecting those fees. If they have not been written and conveyed to the client, and it's an implicit understanding that you have, then you can get into hot water relative to whether or not they have a legitimate complaint against you. So it goes back to that really, truly needing that written documentation of what your terms are and what the expectations are, as well as the consequences if they don't meet those expectations. Okay? So, let's talk about the idea of your cash and your cash flowing into the business, in and out of the business. It truly starts with your accounts receivable. That's truly where it starts, because that is the primary way that cash is coming into your business, through your core business. Those are your fees. So if you aren't collecting on your fees, then obviously the cash is going to be going out of your business, regardless of what your profit and loss statement says as far as what your income was for the month. Then the other thing is the whole concept of reviewing and comparing your cash flow statement on a regular basis. Compare it. Look at, 3 months at a period of time. What you're also going to see is you're going to see ebbs and flows in your business. You're going to see periods of time where your business has peaks and valleys to it. The other thing that you're going to also see is you're going to start to see peaks and valleys in your accounts receivable. Because your client base, if you send a bill in December and you do not have well-defined terms and well-defined consequences, Are you going to get paid in January? Probably not. Because there's a lot of financial institutions that do have well-defined terms and pretty severe consequences if payments aren't made. So you truly need to have those written because one totally builds on the other. Now, it kind of goes back to, if you ever get a line of credit at a bank, don't be surprised if they ask you for a statement of cash flow. And what I will say is if you don't provide one to them, they will create their own for you. And they'll create it with your income statement or your profit and loss and your balance sheet. Because they do want to see the ebbs and the flows of the cash coming into your business. And you can generate a very rudimentary statement of cash flow or cash flow statement with a balance sheet and an income statement. Okay. Questions? You all are so mesmerized by accounting, I know. Yes.
For a very small firm of 2 people, what's the most cost-effective, efficient way that you would recommend we outsource our bookkeeping? Whether we use QuickBooks Online and then send the data to an accountant or something else? Could you just...
Sure, I can talk on that. So what I'm going to say is lawyers are excellent at the law. And just like I would not even consider writing a contract without sending it through my attorney and saying, I need you to proof this and look this over. And he does. I think a lot of legal firms try to do their own bookkeeping because, well, we can do this. And my response is always, nobody's saying you can't do this. I know intellectually you're more than intelligent enough to do this, but is it a good use of your time? And what you bill at, how many hours have you actually spent trying to do something? Now, you're in a situation where if you have Clio and you have QuickBooks Online, you truly, there is enough automation out there that someone can give you a packaged, and I'm a huge flat fee advocate so that you can budget it. I think the worst thing that accountants can do is not give you a flat, fee so that you can budget it. The idea that, well, we've spent this much time this month and this much this and this makes it virtually impossible for you. And honestly, the smaller the firm, the more difficult it really is because you have these wide variances of it. But with automation, you don't even have to be involved in that process. There's lots of different applications out there. HubDocs is the first one that comes to mind that actually goes out and fetches all your bank statements and brings them in and can actually, with a picture from your cell phone, you can actually document all your receipts for any kind of credit card charges or anything like that. So the biggest thing is you need to work with somebody that is familiar with Clio, so they have the ability, if something doesn't come through correctly or there's questionable, that they can actually go look and see what the source is and say, oh, okay, that's how that happened. This is what needs to be done. And as we all know right now, there are still some integration hiccups between Clio and both Xero and QuickBooks Online, where you are still writing your checks out of QuickBooks in order for your advanced client costs, and that information does not push back into Clio. So you have to do a reconciliation at the end of the month in order to compare those two to have them move forward. Does that help?
also loop in an accountant at some point to do something with it?
So, so what I can say is there are a couple firms that I'm aware of. We are one of them that does what we refer to as quarterly reviews. We will come in once a quarter, again for a flat fee. We'll come in once a quarter and review on a firm your size. We'll review what you've done over the last 3 months, review your bank reconciliations, make sure that those have all been done, and say, yep, you're good to go. The advantage of that is when you come to tax season and you want to hand your books over to a tax accountant to do your taxes, you know that they're not going to push them back at you and say, okay, this makes no sense. Now, you can easily do the daily transactional stuff, absolutely. Absolutely. Any other questions? So you all are junior accountants? Okay, yes.
I use Zero.
Uh-huh.
I just wondered if it would automatically create a cash flow statement, or whether you have to do it manually.
Okay, so here's the thing. Both Xero and QuickBooks Online automatically generate these, okay? But what they do is neither one of them have been, they're going to be a far more complex in what they do. And as a result, what our experience has been is because of the complexity of the report, it then becomes overwhelming. And it's like, nope, this doesn't work for me. Too much information, I won't look at it. I know about 8 years ago, we had a personal injury legal firm that came to us. They wanted us to take over their books. We did some consulting to find out what they were coming off of, why they were changing, et cetera, et cetera. They had the most amazing reports. And we're looking at these going, but the problem is that from an accounting perspective, they were amazing reports. The attorney, they meant nothing to him because they were too complex. And it was like he had everything, but he wasn't looking at them because they were overwhelming. And so it always got pushed aside, and it was sort of the Saturday morning thing, and then his daughter wanted to play tennis, and so it became the Saturday evening thing, and his wife wanted to go out, and it became the Sunday morning, and, so if Xero and QuickBooks Online, if you use their statement of cash flow or cash flow statement, what I'm saying is modify it. Make sure that it's going to be of value to you rather than what they do as the default, because the default is going to be far more complex than what you're going to want to go forward with. No other questions? Man. Thank you. Thank you.